Hello guys, hi, how are you all? I hope you're all doing good. Welcome back to CA Intermediate Advanced Accounting Marathon Revision. We're in lecture 2 out of 4-part revision. So the entire sessions are planned in this way, 4 sessions of 1 hour each, wherein we'll be discussing all the concepts of CA Intermediate Advanced Accounting. Yeah, in the first session, as you all know, we've discussed ESOP as well as buyback of equity shares along with equity shares with differential rights. In this session, we'll be doing amalgamation, internal reconstruction. If time permits, we'll touch little liquidation as well. Yeah, don't worry, 4 videos mein I'll complete all the concept revision. Yep, chalo. Before we get started with amalgamation of companies, I have a small announcement to all of you people. The flagship model of Unacademy CA iconic programs is here for all of you people. You can take the best advantage of this by taking up the subscription for iconic model. You all know how beautiful and how marvelous the plus model is. The iconic model comes with additional facilities of hard copy of the materials being available to you at your doorstep. You also get the advantage of taking up evaluated mock test series, and you also get one-to-one live mentoring, one-to-one doubt solving, and whatnot. All the benefits. Even get to be part of not discussion channel for all your doubts. So what are you waiting for? Take up your Unacademy iconic subscription today. Enjoy the benefits of one-to-one live mentoring, evaluated test series, and also quite a lot more. The subscription for CA Intermediate Iconic comes at a cost of 30,000 for 6 months, and it comes at the cost of 38,250 for 12 months and 62,000 for 24 months. Yeah. If in case you use the code YESHAS LIVE, which is YESHASLIVE, you get 10% off on the price that you saw just now on the screen. You can also prefer to take up CA Foundation Intermediate subscription. You can tell this across to your friends who are right now venturing into CA and then taking a foundation subscription. That's available at the cost of 49,500 for 12 months and 66,000 for 24 months. So what are you waiting for? Take up an Academy subscription today and join us in mainstream learning of wholesome regular I would say batches. Yeah, the link to the profile of mine of an Academy is available in the description to this video. You can go down to the description, click on that and follow me on an Academy. And don't forget to like, share and subscribe this YouTube channel for more such content on CA Intermediate as well as CA Foundation. Yep, chalo, let's get going. As I mentioned, in this advanced accounting quick revision or marathon revision the day before examination, we have successfully completed the topic of chapter 3, chapter 4, that is employee stock option plan and buyback of equity shares in the previous lecture, lecture number 1. You can go back to watch that if you are wanting to read these two topics. And in this video, we'll start with chapter of amalgamation of companies, which is chapter 5, which is from page 88. Chalo, let's get started with page 88. We are now doing amalgamation of companies. The weightage for this chapter alongside with ESOP, buyback and internal reconstruction is 33 to 38%. From this chapter alone, you can expect minimum 15 and maximum of 20 marks. There were 2 attempts, November 18 and November 19, wherein no question had come from this chapter. But however, 20 marks had come in May 18, 10 plus 5 marks, one 10 mark question, one 5 mark question in May 19, one 15 mark question in November 2020 and 20 mark question in January 2021. So what is it going to happen in May 2022? You are going to tell me after your exam. You can definitely come back and then drop a comment on this video. If this marathon revision actually helped you in preparation, you can also text me and then tell me as to how beautiful or how helpful was this in your examination preparation. Come on. And I've also put in some topics which are must revise the day before exam. This is for you. Later when you download the PDF, read through this. For now, I'll get going. So I usually explain what is amalgamation, what is merger, what is acquisition. Yeah, when one company acquires the other, it is acquisition. They both come together to form a new company, merger. Yeah, both liquidate and then start again. It is what? Merger. Same company starts another new company to take over this old company, external reconstruction. Same company without any liquidation changes the entire inner structure of finance, internal reconstruction. Yeah, let me make it easy for you. Yeah, Vodafone and Hutch. Vodafone took over Hutchinson. Vodafone bought Hutchinson SR in India. So this, my friends, is acquisition. Yeah, Vodafone and Idea collaborated to form V, that is merger. Yeah, and here Flipkart took over Mintra. Flipkart took over Jabon. These all acquisitions. And UTI transformed itself to Axis Bank. This is external reconstruction. Yeah, means they formed a new company called Axis Bank which took over the entire operations of UTI. If in case you don't incorporate a company, there is no liquidation. Within the company, you make all the transformation. That's what we call as internal reconstruction. You get this? So to understand what is amalgamation, the definition is given by para 3A of accounting standard 14. It says amalgamation means amalgamation as per the provisions of Companies Act. Further, it also includes merger. Yeah. For the purpose of accounting, we'll categorize into three categories: amalgamation, absorption, and external reconstruction. No, this is for the purpose of corporate restructuring. Accounting wise, we'll say it has amalgamation nature of merger and amalgamation nature of purchase. We'll come back to that little later. As I mentioned to you, what happens in the case of amalgamation? Two or more companies are wound up and one new company is formed. What happens in absorption? One company is liquidated because the other continuing company will acquire it. See here, an existing company may take over the business of one or more existing companies. External reconstruction, one new company is formed to take over the business of another old company. See, newly formed company takes over the business of existing company. That is external reconstruction. Now, in the case of amalgamation, there is two or more companies getting liquidated and new companies getting incorporated. In the case of absorption, one company or more companies will get liquidated and there will be no new incorporation. There will be no new incorporation. There is no new company getting incorporated. You get this? However, in the case of external reconstruction, there will be no liquidation. Sorry, liquidation of only one company will happen and one new company is incorporated. That is the difference between absorption, amalgamation, and external reconstruction. All these three together is called as corporate restructuring. The bigger word, the big term. You get this? Hello. Let us get going now and then see who are the parties. There are two parties to amalgamation, absorption, or external reconstruction. One is transferor, other one is transferee. Transferor is a small company which is getting liquidated, whose business is being taken over by someone. Transferee company is either the new company or the existing company which is taking over the business of the transferor company. I hope you guys got this through. Yeah. Then let's see what does accounting standard 14 has to say about amalgamation. Yeah, I was just checking if the recording is going in fine place. Yeah. Accounting standard 14, what does it say about amalgamation? Accounting standard 14, which deals with amalgamation, absorption, and external reconstruction, it prescribes how to do accounting in the books of transferee. In the books of AS 14 only tells how to do accounting in the books of transferee. AS 14 is quite about how to do accounting in the books of transferor. Transferor is a small company. A transferor company accounting is not prescribed by AS 14. Whenever we do accounting in the books of transferor, it is how it's told by GAAP, generally accepted accounting principles. We go by that. For transferee, we do it how it's given in accounting standard 14. You get that? Yeah. So there are two kinds of amalgamations as I mentioned to you. One is merger, other one is purchase. This bifurcation or this classification is given under accounting standard 14. This is not corporate restructuring, the white term that's used generally. Yeah. Amalgamation includes two forms. One is in the form of merger, other one is in the form of purchase. Now, how do we decide whether it is merger or purchase? Yeah, it is dependent upon conditions. Accounting standard 14 has given 5 conditions. If all the 5 conditions are fulfilled, it is merger. Even if one out of 5 conditions is not satisfied, it is purchase. You get this? Why do we have to check these conditions? Because based on these conditions, we'll categorize it as merger or purchase. The accounting treatment that we do when it is merger is quite different from the accounting treatment that we do when it is purchase. If it is amalgamation in the nature of purchase, accounting is done under pooling of interest method in the books of transferee. I will show you the accounting entries wise also the difference. However, when it is amalgamation nature of purchase, accounting is done under purchase method. Got it? I hope you all learned this part clearly. So if it is accounting in the case of merger, we do it under pooling of interest method. If it is accounting in the nature of purchase, we do it under purchase method. Yeah. So now what are these 5 conditions based on which we decide all of this? Yeah. Before we go there, how is the accounting done in the books of transfer? I don't know. AS 14 is silent about it. AS 14 doesn't say how to do accounting. Why? It's quite obvious, no? I told this to you a little while ago that accounting standard 14 only talks about transferee. Accounting standard only talks about transferee. With regard to transferor, I don't know. You do what you want. Yeah. So AS 14 is quiet. We follow gap for accounting standard 14 accounting in the books of transfer. Got it? Yep. So what are the accounting entries, guys? Before that, 5 conditions. Condition number 1. All the assets and liabilities of the transferor should be taken over by transferee. You cannot do hand picking. This is not tarkari business. You will take some, you will not take some. Tarkari means in vegetables. Yeah. You have to take all the assets and all the liabilities of the transferor company. When I say all the assets and liabilities, including reserves and so. If it is taken over, it is merger. If you leave out some assets with the transferor only, it is merger. It is not merger, it is purchase. You get this? Then there is a continuation of this. All these assets and liabilities which are to be incorporated in the books of transferee company should be at their book value. Yeah, except for the case where there is difference in accounting policy. They follow different accounting policy, you follow different accounting policy. To bring uniformity in the accounting policy, what you can do is you can change the, or to say, the value of the asset. If not for that, the value of the asset should be book value. Transferor book value should be recorded in transferee's balance sheet. You get that? So it is a fifth condition. Sir, 1 over 5. Next we do 2, 3, 4. Yeah. What is the second condition? Minimum 90% of the shareholders of transferor company should continue to be shareholders of transferee company. In that company, the transferor, small company, how many ever shareholders were there? Among those, 90% of them should continue to be shareholders in a new company also. How is that possible? In order to make that possible, you, in your purchase consideration to the shareholders of transferee company, you should give equity shares only. Yeah, come on. Look at this third condition. Consideration to shareholders of transferor company who agreed to be the shareholders in transferee company should be in the form of equity shares in transferee company. The old company shareholders are there, no? To them you should give equity shares in new company. Then they should become shareholders in new company. Minimum 90% of them should continue. If you don't give them equity shares as consideration, or if minimum 90% of them don't continue, then it will not be amalgamation nature of merger, it will become amalgamation in the nature of purchase. You get this? However, certain times you will not be able to give them equity shares as consideration. Why? The ratio that you agreed about is 1 share for every 3 shares held in that small company. 1 share in the transferee company for 3 shares held in the transferor company. What if there is a shareholder who was holding 4 shares in transferee company or a transferor company? Against the 3 shares that he holds, you give 1. Against that 1 share, you can't give what is say 1/3 of the share in the transferee company. Why? Share is already a share in the share capital. How can you do sharing in the share capital? Let me repeat. Share is already a share in the share capital. How can you share the share further? No, 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 no. Yeah, what is already shared into small parts, you can't share it further. It will become very small tukadas, guys. Don't do that. It will become so small that you can't pick it up. Don't do that. Yeah, so shares cannot be further shared. So what do? You can't give fractional shares. Okay, sir, what do? We give them cash. For the fractional shares, it will be settled in cash. For other than that, we give them shares. Do you get this? Except for the fractional shares which are settled in cash. And lastly, you buy their business not for the sake of their assets or not for the sake of their accumulated losses which you can adjust against yours to save tax. No, that's not the intention. The intention why you take over their business should be to continue your business, to continue their business as your business. So what should you do? The business of the transferor is to be continued by the transferee. It is, there should be intention that you want to continue the business of the transfer. Got it? So these are the 5 conditions. If you satisfy all of these 5, it will be amalgamation in the nature of merger. If not, it is amalgamation in the nature of purchase. Now let's go down to see how should the accounting be done for each of this. Yeah, before that, whenever we start with accounting, we record assets, we record liabilities, then we go down to write purchase consideration. Yeah, we need to understand what is this purchase consideration, what are the what to say various forms in which the purchase consideration can be decided upon, agreed upon, and then settled. Yeah, what do you mean by purchase consideration? It is a consideration given, something in return for the purchase of the business. Now I am a transferee company. I acquire the business of the transferor company. When I, transferee company, acquire the business of the transferor company, I pay them some money, maybe cash, maybe equity shares, preference shares, debentures, whatever. When I give that, what I'm giving in return for taking over their business assets and liabilities is, my friends, purchase consideration. So purchase consideration is what is given by the transferee company to transferor company on acquisition of the assets, liabilities, as well as the business of the transferor company. I have a beautiful question to all of you people. All the people who are interested in the company, I've categorized them into three major classifications. Who are they? Let's say these are equity shareholders of the company, and let's say these people are preference shareholders of the company, and let's say these people are, what do you say, debenture holders of company. All three of them would have contributed money to my transferor. These are equity shareholders, preference shareholders, and debenture holders of my transferor company. When I acquire the transferor company and their business comes to an end, these people have to be compensated by me. Now, I might give equity shares in transferee company to these equity shareholders. I will give preference shares in transferee company. I'll give them debentures in transferee company. I'll give them cash. I can give all of this, no? Similarly to preference shareholders of transferor company also, I can give equity shares in transferee company. I can give them preference shares in transferee company. I can give them debentures in transferee company. I can give them cash. Same with regard to debenture holders of transferor company also. To debenture holders of transferor company, equity shareholders of transferor company. What do we do? What do we do? We can give them equity shares. We can give them preference shares. We can give them debentures in transferee company. Now tell me, what and all would form part of PC? Would everything form part of PC? Or would you say like equity shares, preference shares, equity shares, preference shares, equity shares, preference shares would form part of PC? Or whatever is paid to preference shareholders and equity shareholders comes part of PC? When I ask this question in class, I get a lot of answers. A lot of them say, sir, equity shares and preference shares given will be part of PC, irrespective of whom do you give it to. Some say, hey, no, sir. What matters is equity shares, preference shares, debentures, cash, anything given to equity shareholders and preference shareholders. It doesn't matter what you give, sir. It matters only about to whom do you give. Now, these two people are third category of people say, sir, sab kuch. Everything is Maya. No, everything is PC. Whether you give it to equity shareholders or preference shareholders or debenture holders. Now, who among these three are right? Does it matter about whom do we give? Or it doesn't matter whom we give, sir. All that matters is what we give. Or is it like it doesn't matter whom we give? It doesn't matter what we give. Everything we give is PC. Is it so? What's the answer? I hope you marked your answer. Let me tell you something. What really matters is to whom are we giving. What really matters is to whom are we giving, not about what are we giving. PC is what is given to preference shareholders and equity shareholders, irrespective whether it is equity shares in transferee or preference shares in transferee company or debentures in transferee company or cash, or whether it is equity shares in transferee, preference shares in transferee, debentures in transferee or cash given to preference shareholders. If you give it to the shareholders, may it be equity, may it be preference, it is purchase consideration. If you, however, issue it to your debenture holders, if you issue it to your debenture holders, it is not PC. If you issue it to your equity shareholders or your preference shareholders, it is PC. So what matters with regard to PC is to whom are you giving and not what are you giving. What matters is to whom are you giving it and not what are you giving. If you are giving it to equity shareholders or preference shareholders, no matter what you give, guys, it's PC. Got this? Chalo. There are multiple methods to compute PC. Yeah, you might think I'm going fast because this is marathon revision, guys. The day before exam, we have so much to do. Yeah, there are multiple methods. First method, lump sum method. Lump sum method, what do we do? Lump sum money that is given by way of consideration to transferor will be given to us. Yeah, payment method, they will tell these many equity shares given, these many preference shares given, this much cash given, this much debentures given. They'll give multiple forms in which the consideration is settled. Mix it up all, you get purchase consideration. That is payment method. Yeah. Or they give ratio, like okay, for 2 shares in transferor company you get 1 share in transferee company. For 3 debentures, for each preference shareholder in transferor company, you give 1 equity share, 1 preference share, 1 debenture. They give some ratio. Using that we'll find, that is payment method. And the last one, third one is net to asset method, wherein you will be given with the agreed values of the assets and liabilities of the transferor company. They will tell, this asset is taken over at this value, this liability is taken over at this value, this asset is valued at 0. Revaluation figures, the revised figures of all the assets and liabilities will be given. Add all the assets, deduct all the liabilities, what you arrive at is net asset value. To that, if you add goodwill or deduct capital reserve if any, you get purchase consideration, my friend. You got this? And lastly, we have intrinsic value method. What's intrinsic value method? Under intrinsic value method, what happens is, it's like now transferor company's shareholders will get shares in transferee company. Till now our focus is only on transferor company. We're trying to value the shares of transferor company, but consideration is given by shares in transferee company. So transferee company shares also should be valued. In exchange of transferor company shares, you're getting transferee company shares. No, you will say 1 share in transferee companies for 3 shares in transferor company. Boss, when you arrived at this 1:3 ratio, how did you arrive at the ratio? How do you say that 1 share in transferee is equal to 3 shares in transferor? So you need to value this. If this value is 150 rupees and value of the share in transferor company is 50 rupees, then you say 3:1 is the ratio. So to arrive at such ratio, you can always go with intrinsic value method. Amazing method, where we'll do valuation of share for both transferor company as well as transferee company. If the question is on intrinsic value method in the exam, marks will come in heaps, not in small quantities. Got this? That, my friends, is intrinsic value method, wherein we do valuation of both transferor as well as transferee. Now let's quickly see what, okay, goodwill or capital reserve is the difference between net assets taken over and purchase consideration. Net assets taken over, the revised value of all the assets minus the revised value of liabilities. When we do, what we get is the net assets taken over, NATO, the value of the business that we took over as transferee. That should be the consideration that we pay. If our consideration that we pay is more, then as a transferee I'm paying more than the value of assets that I'm getting. That is goodwill. If I'm paying less, if I'm paying lesser than the value that I'm getting, then I'm under profit, my friends. It's capital reserve. So if net assets taken over is greater than purchase consideration, then what is the difference called as? Getting more assets than what you paid for. So that is your profit. We'll write it to capital reserve. On the other way, if net assets taken over is less than purchase consideration, which means that you're paying more for assets which are not seen, which are intangible, that's what we call as goodwill. Got it? Hello, let's quickly go in and then see the accounting side of this. Accounting entries in the books of transferor is what we're seeing. In the books of transferor, what we should do first, transfer is the company which is getting closed. We need to transfer all the assets, whether taken over or not, at book value. Because if the assets are taken over by transferee, good. If the assets are not taken over by transferee, still the transferor is getting liquidated. So you would have to settle those, sell those assets or settle those liabilities. So all the assets will be transferred to the realization account at book value. Assets will have debit balance, so we'll credit the assets and debit realization account. Journal entry will be realization account debit to assets account. Yeah. And one important thing is, there is a beautiful exception, cash. Cash is not transferred when it is not taken over. Why? Maybe certain liabilities are also not taken over by transferee. You will use this cash to pay those liabilities. In such a case, you don't transfer cash. Got it? Very good. So however, fictitious assets, accumulated losses, reserves if any will not be transferred. Fictitious assets, accumulated losses will not be transferred to realization account. Instead, this will be transferred to our shareholders account. After reducing their share capital with this accumulated losses, fictitious assets and all, we'll settle them with consideration received from transferee company. So point number 1, assets transferred, you need to write realization account debit to assets. Assets which have debit balance are credited to be closed and we debit it to realization account. Fantastic. Next one, we need to transfer all the liabilities. Before that, assets are to be not transferred at agreed value, guys. Assets have to be transferred at book value. Yeah, agreed value is never considered. It's a big no. Remember, a lot of them in the anxiousness about the exam, they forget. It is never considered. Agreed value is never considered. What is considered is always book value for transferring to realization account. Done? Yeah, it is only considered in book value. You write that. Yeah, then what do we transfer? We'll transfer the liabilities to realization account. All the liabilities, whether taken over or not by the transferee, it should be transferred to realization account at book value. Liabilities will have credit balance. In order to transfer them, we have to debit the liabilities and credit realization account. Yeah, see this entry is liabilities account debit to realization account. All outsider liabilities should be transferred to realization at book value. Yeah, items not to be transferred are share capital, reserves and surplus. Why? Along with these fictitious assets and accumulated losses, we will transfer share capital and reserves and surplus also to shareholders account. When we transfer share capital and reserves and surplus to shareholders account, we'll understand how much money is payable to shareholders. When we transfer accumulated losses and fictitious assets to shareholders account, we'll understand how much money is to be decreased from the amount payable. After these two entries, we'll arrive at net amount payable to shareholders. This net amount payable to shareholders on sale of their business will be settled by giving them the purchase consideration that we, liquidators of transferor, received from transferee company. Whatever consideration we received from transferee, we'll give to the shareholders. That will be our closing entry in the books of transferor. Got it? Yep. Next up, after you close all the assets and liabilities, your balance sheet is closed. Now what do we do? This entire balance that is there in the realization is now getting transferred to transferee company. Transferee company will receive these assets and liabilities. Why? Because they are purchasing our business and they are giving us purchase consideration. The next entry is transfer of all these assets and liabilities to transferee and writing the PC that we are supposed to receive. PC is supposed to be received from transferee company. So we'll write PC, I'm going to say transferee company account debit. Sir, why do we debit transferee company account? Because purchase consideration is receivable from transferee company. Why are they supposed to pay purchase consideration? Because we are giving them assets and liabilities. All the assets and liabilities are right now there in realization account, which will now be credited to give them. And they are supposed to give us what? Purchase consideration. So PC due entry is transferee company to realization. What do we do later? We will receive the purchase consideration from them. It can be in the form of cash, bank, equity shares in transferee company, preference shares in transferee company, debentures in transferee company. We're receiving all of these, guys. We're receiving equity shares, preference shares, cash, bank, all of this we're receiving. When we receive all of this, we'll debit it because we're receiving. We're receiving from transferee who was supposed to give this to us. When we told he's supposed to pay us, we had debited his account. Now when we receive, we will credit his account. For which the journal entries, cash account debit, bank account debit, equity shares in transferee, preference shares in transferee, debentures in transferee account, debit to transferee company account. By this, we have received our PC. This PC due entry, whatever we passed here, is now nullified here. Then what do we do? When we transferred all the assets here and all the liabilities here, we didn't see whether they were taken over or not. Yeah, there can be certain assets which are transferred here to realization, or there can be certain liabilities here transferred to realization. But all of it is not transferred to transferee here. Why? Transferee wishes not to take over certain assets or liabilities. What do we do in such case? We need to sell those assets. We need to settle those liabilities. If in case we sell those assets, for sale of assets, usual journal entry is cash to assets. We can't write cash to assets here. Why? Cash account can be debited, but assets account is no longer there. Asset account is already closed by crediting realization. Now we'll write that to realization account only. Our entry for sale of assets is bank to realization. Our entry for settlement of liabilities is realization to bank. In the process of this entry, we don't care whether we're making profit or loss. What is the value of the asset? What is the asset value realized? We don't care. We don't try to account for difference between cost price and selling price. We will write the entry at selling price only. Ignore the profit. Why, sir? Previously, in the realization account, debit side we have written 2 asset at book value. Now we'll write credit side by bank selling price. Difference between the selling price and book price automatically will result in realization profit or loss. which will be later transferred to shareholders account. So don't try to account for profit or loss separately. Just write selling price to realization account. Just transfer the cost of the asset to realization. Realization account may automatically will find profit. Same with liability. Don't try to figure out profit on settlement of liability or loss on settlement of liability. Just write the settlement value. If you have received, if you paid more, it will result in loss. If you paid less, it will result in profit, and that will automatically get adjusted in closure of realization account. You don't have to do anything separate. I hope you guys got this. Fantastic. And if in case they have not mentioned the value of realization of the asset, always assume it to be zero. Like this. You remember this movie of Shah Rukh Khan, zero? Yeah, like that. Remember the value of the asset to be realized as zero if value is not mentioned. Why? Prudence. Prudence, conservatism principle. You get this? However, if for liability they have not mentioned anything, we'll assume it to be settled at book value. Why? Against prudence or conservatism. Got it, guys? Fantastic. After all of this, selling those assets, selling those liabilities, entering into agreement with the transferee, receiving that consideration, all of this is a very hectic process. This entire liquidation or realization process is going to cost you some money. In fact, it's going to cost you an entire salary of liquidator and his commission and all the remuneration that you need to pay him, and a lot of paperwork, legal responsibilities also. For all of this, when the expenses are incurred, we will not write it to any separate expense account. All the losses and all the expenses in the process of realization will be returned to realization account only. So whenever realization expenses are incurred, we will write as realization account debit to bank account as expense. If this expense is paid by transferor and if this expense is paid by transferor, as in we, the small company, we paid it, we write this entry. If we are only bearing it, then no entry for bearing it. Why? Already returned to realization account debit. However, this expense what we paid, no, it's getting reimbursed from transferee. Transferee is telling, I am acquiring your company. For that you're paying this. It's okay. I'll pay this money to you. If our transferee tells this, whatever expense as a transfer I've paid, I'll get it back. When I get back, I'll reverse the entry what I passed when I paid. When I paid realization expense, I wrote realization to bank. When I receive it back, I'll write bank to realization. So this entry what I wrote here is getting reversed because it's no more my expense. Why? He's bearing it, not me. I hope you understood the entries for realization expenses. Next, paid by transferee. If the transferee only pays my realization expense, I have to pay. I didn't pay. He only paid straight. I will not write any entry. No entry, no entry. Why? He is paying my expense. I would not pass an entry. However, he paid it on my behalf. And now I have the responsibility to pay him. What do I do in that case? Then I would have to pay him my bank account credit. And it doesn't really matter whether I pay the expense straight or I pay to my transferee. Entry will be realization account debit to bank account. I hope all of you understood this part. Yes or no, guys? Fantastic. Next, whatever the purchase consideration that we need to pay to preference holders, we'll pay them. Before that, we need to create a payable entry wherein we'll debit our share capital, credit their preference shareholders account. We'll write preference share capital account debit, we'll credit their preference shareholders account. If you're paying them more, that is realization loss to us, I will debit it. If you're paying them less, then it is realization profit to us, I'll credit realization. You get this? Then whatever this preference shareholder account which is debited here will now be closed. What do I do? I'll write preference shareholder account debit to whatever consideration we give them. They can be settled by giving equity shares in transferee company or preference shares in transferee company or debentures or even cash. We'll give them whatever, we'll create whatever we're giving them. Equity shares or preference shares or debentures or even cash. Whatever we give them will now be credited, and that, my friends, is the end of the story for preference shareholders. Next up, we need to identify realization profit or loss after settling all the liabilities which are not taken over, after realizing all the sum from the assets which are not taken over, after settling the preference shareholders, what money will I be left with? Yeah, if it is profit, that profit should go to equity shareholder, so we'll credit equity shareholders account credit and debit will be given to realization. If it is loss, such loss again should be borne by equity shareholders. Their capital or the amount receivable by them will reduce. So I will debit my equity shareholder account and then give credit to realization. So for profit, the entry is realization to equity shareholder. For loss, the entry is equity shareholder to realization. Once we do this, we'll transfer our share capital and reserves which is payable to equity shareholders also to their account, for which the entry is equity share capital account debit, reserves and surplus account debit. If there is accumulated losses, it will be credited, and then we give the credit to equity shareholders. Credits will increase the shareholders' money payable to them, debits will decrease. So ultimately, we'll understand how much money should be paid to equity shareholders, which will be settled by the PC received from transferee company. See, whatever PC that we had received, X% shares in transferee company, equity shares in transferee company, debentures in transferee company, cash in transferee company, all this will be given to our equity shareholders to settle their account. Do you got it? Yeah. Further, they can ask ledger accounts sometimes instead of journal entries. If they ask ledger accounts, prepare whatever ledger accounts that they've asked. Sometimes they might just say prepare necessary ledger accounts. When they say prepare necessary ledger accounts that you should prepare are realization account, transferee company account, preference share capital, and equity share capital account. Sorry, holders account. If in case they ask for any other specific ledger, prepare that. If not, just prepare these four. That would do the job. By this, we finish accounting in the books of transferor. We should now learn how to do accounting in the books of transferee, the big company which is taking over all of this. Shall we see accounting in the books of transferee? One moment. Okay. Accounting in the books of transferee company. It will include journal entries. Sometimes they might ask for ledger accounts, and then we'll go on to prepare balance sheet. Yeah. So accounting can be done under two methods: purchase method, pooling of interest method. Depends upon the nature of merger. If it is amalgamation nature of merger, if it is amalgamation in nature of purchase, then we'll do purchase method. If it is amalgamation in nature of merger, then we'll do pooling of interest method. Did you guys get it? If it is merger, we do pooling of interest. If it is purchase, we do purchase method. Sir, you didn't teach us any different kind of these things under transferor companies books. Under transferors books, no, there are no two methods. You are dying. How do you die doesn't matter. Whether you die by, okay, fine, it's an offensive topic. Let's not talk about that. Yeah. Why to talk about death and all now? Death of partner is now shifted to CA foundation. So CA inter is not the place to talk about death. Let's not talk. Yeah. So when the company, transferor company is dying, we don't really go to account, how to account bolke, there's no specific differentiation. Just close by realization method. However, when you're going to be born as a new company, then accounting matters. Either you can do purchase method or you can do purchase methods. Purchase method is done when it is purchase. Merger may we do pooling of interest method. Yeah. So what is the entry? First entry is for the business acquisition. Transferee company acquires the business of the transferor company. And transferee company acquires the business of the transferor company. Your purchase business, my friend, debit business purchase account, and you have to pay consideration to the liquidators of transferor. You have to pay consideration to the liquidators of transferor. So you will write the entry as liquidators of transferor. Sorry, it's a typing error. Don't be angry on me and then like no, it's transferor. Yeah, don't say like sir what tree, you should put yeah, it should be I know it's not tree. Yeah, so whenever the business is acquired, the entry that the transferee should pass is business purchase account debit to transferor account. You get this? Entry will be same even in the case of pooling of interest method. Like remember this guy during the 2019 World Cup when Virat Kohli spoke for 2 good minutes about how is it going to be just another match, and India Pakistan match is no different for an international cricket player. He spoke for good 2 minutes explaining the same, and then the MC went to Pakistani captain and then asked him, what do you have to say about India Pakistan match? Then he says, my answer also same, no difference. That's the maximum English that he could talk. Yeah, He told what Virat Kohli told is also my answer. You don't do this in the exam. You don't tell like, okay, my neighbor, whatever answer he wrote, same my answer also. Same answer. You can't write that in the exam. You'd have to write your answer. Remember that. Don't use your brains in the exam like that. Huh? Next, you acquired no business. Business purchase the box. Transferor calls this box as realization. As a transferee, you will call this box as let's say business purchase. To him, it is realization account. To you, it is business purchase account. This box, no, you open now. Transferee, you ordered it, you got your parcel, you open it. From that, what pops out is assets, liabilities. It all pops out. Those assets and liabilities will be incorporated in the books of the transferee. You are transferee now. So you will debit all the assets, credit all the liabilities. Business purchase, whatever you debited, that we will credit now because that is the box that you are opening now. Credit it. And in the case of purchase, you will write goodwill or capital reserve. That is for goodwill account debit when PC is more than NATO. Capital reserve account credit when PC is lesser than NATO. Yeah. However, when you do merger, no, you are all one. There is no difference. You cannot say I made profit, I made loss. You're all one family. So what do? You will write it to reserves and surplus. You will write it to reserves and surplus. This is one point of difference between purchase method and pooling of interest method. Under purchase method, you account goodwill or capital reserve. Under pooling of interest method, you don't separately record any goodwill or capital reserve. All that you do is entire goodwill or capital reserve, which arises as difference between PC and NATO, will be adjusted through reserves of the transferor company what you've taken out. Did you get it, my friend? Done. So all the assets have been incorporated. Business purchase has been closed over. But this is still there, no? Liquidators. Liquidators need to be settled. Next entry, my friend, is settlement of purchase consideration to liquidators of transferor company. What is it? Settlement of purchase consideration to liquidators of transferor company. How are we going to settle? We'll give them equity shares, preference shares, debentures, cash, bank, whatnot. So entry will be liquidators of transferee company account debit to debentures, preference share capital, equity share capital, security premium, cash or bank. You get this? This is the entry in the case of purchase method. If you have given it shares at premium, you will credit premium. If you have given shares or debentures at discount, shares can't be issued at discount though. Section 53 of Companies Act 2013 stops us. Yeah, sir, law exam is over. Okay, but audit exam is still pending. You will debit it to discount account. This is the entry under purchase method. What is the entry under pooling of interest method? Huh? Pawan Kalyan tells no. Sudappa, Sidappa, I am like lion. I'm like tiger. Tiger doesn't shave. I shave. That's the only difference. Rest everything is same to same. Here also same to same. Whatever you wrote in the books of transferee company in the case of purchase method, same entries will come in the case of pooling of interest method also. What is it? Same to same. No difference. Yeah. Like Pawan Kalyan says, same to same. No difference. I hope you got this point. Fantastic. Then you need to discharge purchase consideration. So this is to debenture holders. If you give debenture holders, the debentures, equity shares or preference shares will write here. Similarly, you give purchase consideration to equity shareholders as well as preference holders. There also will write the same. Liquidators, ouch. Liquidators of transferee company account debit, and you give them equity shares, preference shares, debentures. You can give them at premium or you can give them at discount or cash or bank, whatever is done. For these entry will be same. See, entry for payment of consideration to equity and preference holders and entry for swapping of debenture holders from transfer to transferee is same, but the difference is this payment to equity and preference holders is PC, but payment to debenture holders is not PC. It's not part of PC. I hope you got this point. Hello, let us go to the next part. After you do this, then realization expenses of the transferor, if any you pay, then you need to write the entry goodwill to cash or bank, because what you're paying them, you're not getting anything in return. It's a matter of goodwill that you're paying them. However, in the pooling of interest method, you cannot write the word goodwill anymore. So we'll write profit and loss account or general reserve account and credit to bank account because you're paying it. Done. Mutual indebtedness. If the transferee company had transactions before, debtor creditor relationship or bills receivable bills payable relationship, that should be nullified. How do we nullify this? Creditors account will be debited, debtors account will be credited. Bills payable account will be debited, bills receivable account will be credited. Yeah, so that's the entry. Debtors, creditors to debtors or bills payable to bills receivable. Why do we do this? The reason is previously when transferor transferee were two distinct companies, this debtor creditor relationship was there. When you acquire, you're all one company, no? Now you cannot pay money to yourself. I am my own debtor. I am my own creditor. Hey, what nonsense? क्या फूक के आया? You can't say that I should pay money to myself, no? Really? So what do? We'll nullify debtors as well as creditors. We'll nullify bills receivable as well as bills payable. So liability will be debited, asset will be credited, and that's how we close it, my friend. Got it? Then we have unrealized profit. If there is any profit made by the transferor or transferee by selling the goods to the other party, when they were two distinct entities, it is profit. But when they become one, how can I sell goods to my own company and then make profit? This is only for such sales which is made by transferor to transferee, but transferee has not sold it to outsider. Let me repeat. Transferor has sold goods to transferee. Transferee has not sold the goods to outsider. Or transferee has sold goods to transferor. Transferor has not sold it to outsider. But they went for merger or purchase. In such cases, what happens? There will be some unrealized profit. 100 rupees worth of goods have been sold by transferor to transferee at 120. Now, when they merge, in this balance sheet, stock is at 120, but usual cost is 100. 20 rupees profit is not realized. Should eliminate that profit. So to eliminate that profit, stock has to be credited in both the cases. If it is purchase, we debit goodwill account. If it is merger, we can't use goodwill or capital reserve. So we write it off through P&L or general reserve of the transferor company that we acquired. We take no all their reserves. In the case of merger, we take all their reserves that will get adjusted against this. Then we have statutory reserve. If there is any statutory reserve to be continued by the transferee after merger, then you need to write the entry amalgamation adjustment account to statutory. Sir, how about here? Here you don't have to write any separate entry. Why? When I told you amalgamation instead of merger, I told all the assets and liabilities, including reserves and surplus, is to be taken over. When I say here including reserves and surplus, yeah, statutory reserve is also taken over, so we don't have to write any separate entry. Got it? That's it. After this, mutual indebtedness will be adjusted. No, I told that, and unrealized profit also I explained. Statutory reserve is also done. Then there are certain disclosure requirements which you need to comply with. Once you're done with that, you are done. And after this, you need to prepare balance sheet. Balance sheet of the transferee company. Remember, when you're preparing balance sheet of the transferee company after merger or purchase, you need to keep their old balance sheet of the transferee company plus the accounting entries what we passed. You add both. That's how you arrive at the balance sheet of the transferee company after merger or acquisition. Done, my friends? If this much is very clearly gone into your mind, then there is no problem that's going to be difficult to you to solve. And that's it. By this, I call the topic of amalgamation to be done. There are several problems. I've compiled all the past examination RTP and MTP questions in this. This is the fast track revision material that I use. You can refer this once you download. Yeah, and that's it, guys. By this, we are done with the topic of amalgamation of companies. What will we do now? Now we will do internal reconstruction of companies. A very teeny tiny chapter, 2 journal entries, and we're done with the chapter. Yeah. So once we finish internal reconstruction, it will be the end of this video, second video. And in the third video, I'll come back with liquidation and banking companies. If time permits, I'll do NBFC. If not, NBFC consolidation and partnership will be our third video. So frankly speaking, third video, we can do liquidation and banking. And in the third video, we'll have NBFC consolidation and partnership. Got it? Hello. So let's get going. Let's start with our internal reconstruction chapter, page number 117. Internal reconstruction. This, along with employee stock option plan, buyback, and amalgamation, come for 33 to 38% of the marks in the exam. However, the past tense says that you can expect about 10 to 15% of the 10 to 15 marks from this exam, from this paper. What I've observed in the past is in May 18, in May 19, and in November 20, also in Jan 2021, there was no question from this chapter of internal reconstruction. It's a very easy chapter. If in case you get question from this chapter in the exam, you should be lucky. And if you guys get 15 marks question, though, you are very, very lucky. Like November 19 people. After your attempt is when we'll get to know whether you people were lucky to get question from internal reconstruction or not. A very easy topic. What kind of questions will be asked in the exam I've given here. What to expect from this chapter. You can read this in your last minute preparation so that you can practice problems. Now let me jump into the topic. Yeah, the balance sheet of the company is in a very bad state. Financial health is pathetic. Means what? Losses are more, huge losses are there, which makes the net worth of the company negative. Meaning share capital is 100 crores, accumulated losses or reserves and surplus negative is 150 crores. So the net worth of the company is minus 50 crores. What does that mean? That means if you sell all the assets of the company, the money that you realize will be insufficient to pay the liabilities. Will be insufficient to pay the liabilities. It's a very, very bad state to be. So how is it possible? There might be some intangible assets which are actually not assets anymore. There might be goodwill or there might be patents which are of no value to the company now, which are of bad, and then like will realize 0 rupees. Against that liability is there, but that asset will realize 0. Or certain assets are there, but they are overvalued. They are valued at a place which maybe there are some debtors which are not realizable at all, which will not get you any cash. So all these things together will make the financial health of the company bad. In this, the company will threaten that I am going to die. I am going to go for liquidation. Everyone will say, why are you going to go for liquidation? They'll say, because I don't have any money to pay you people. So what's happening when you don't have money to pay? When you don't have money to pay, your creditors are not supplying goods to you. If creditors don't supply goods to you, you can't manufacture goods. If you can't manufacture goods, you can't sell goods. If you don't sell fresh goods, your old customers who have already bought goods from you but have to pay you money, they will not pay you money. Why? They're buying goods from somebody else who is asking for cash. So debtors have not paid money, because of which you didn't pay money to creditors, because of which creditors are not supplying goods to you, because of which you are not doing production. There is no cash in the company. You are not paying rent, you are not paying salaries to employees, you are not paying interest on debentures, you are not paying what any of the expenses, you are not paying preference dividend also, you are not giving dividend to equity shareholders. Certain expenses get accrued, which is building in P&L debit side, which will lead to losses. Losses will get accumulated, reserves will become negative, equity shareholders or shareholders net worth will become negative. And if in case you go for liquidation, you will not be able to realize sufficient money to pay liabilities. So what will the company do? Company will put dhamki to everyone. Hey creditors, give me goods. If you don't give me goods, then I will die. Hey, don't die, man. I'll give goods. Creditor won't say that. Creditor will say, okay, you die. I will sell it to somebody else. Creditor say this doesn't work. You will go to shareholders and then put this dhamki. Shareholders will be like, seriously, will you die? Like, yeah. So what? Then you will threaten the shareholders. If I die, you won't get any money. You will get zero. In fact, you would have to pay money in return. Shareholders will be like, so what should I do? You will ask the shareholders, your share capital is 100 crores. No, reduce it to 50 crores. Okay, how man? Like 50 crores loss. Then you say, if you don't accept for 50 crores loss, I'll make 100 crore loss. Then the shareholders will be like, okay, fine, bro. We'll reduce it to 50 crores. By this, what happens? Some liabilities will reduce, no? And within the authorized capital, you freed up some money. What you do? That money is there, no? Now 50 crores of capital is freed. You will use it to pay some liabilities. You will give it to creditors. Will give like, creditors, I can't give you cash. I will give you shares. Will you please give me goods? Creditors might agree. There might be certain debenture holders to whom interest is accumulated for quite long. You will ask them, hey debenture holders, can you please waive off your debenture interest? I will give you equity shares and make you owner of the company. Debenture holders say, hey, I don't want. Then you don't get anything. Why? I am going to die, no. Company will threaten this way. So what will the company do? It will ask debenture holders to waive off their debenture interest, give them equity shares and then settle them. So debenture holders also get revived, liability will reduce. You get this? And then some money is freed up, no, the profit, interest written off, preference dividend written off. All those profits will be transferred to an account called capital reduction account. This capital reduction account balance will be used to write off all the accumulated losses and overvalued assets to realistic values. Now the balance sheet will look clean. With this clean balance sheet, you will take a new life and then start functioning. That, my friends, is internal reconstruction. You revamp the entire company financially without going for liquidation or incorporation. However, if you do it with liquidating this company, creating a new company to take over these assets, that's what we call external reconstruction. I hope you understood what internal reconstruction is all about. Yeah, let us see the accounting side of this. That's it. Assets are overvalued. What has happened to assets? Yeah, huge accumulated losses. And then these are all intangible: copyright, trademark, license, everything. Intangible assets. Zero value. So what do we do? In order to give a true and fair view, the company will go for revaluation. What do you do in revaluation? You revalue the assets, bring the assets down to realizable values, and then like proper figures, bring the liabilities down, record all this to capital reduction, use that to write off the assets. If there is any further money remaining in capital reduction, it will be transferred to capital reserve. Yeah. So the objective is what? Reorganizing the capital, revaluing the asset, compounding the liabilities, writing off accumulated losses without liquidating the company or forming a new one. Because liquidating the company and forming a new one, my friends, is external reconstruction. Got it? Fantastic. So capital reduction, this is with regard to Companies Act, section 66, whatever it says. You can read this a little later, yeah, when you download the PDF. But I'll tell you what is very important. This last line is very important. Read this. Use the words and reduced as on in the heading of financial statement. Whenever they give a question on internal reconstruction, we'll do all the journal entries for revalue the assets, revaluing the liabilities, transferring the funds to capital reduction, writing off the assets, writing off intangible assets, and then using transferring that capital reduction balance to capital reserve closing entry. After you do all of this, they might sometimes ask you to prepare revalued what to say balance sheet after reconstruction. That will be the old balance sheet plus the effect of journal entries that you passed. When you arrive at this restructured balance sheet, on the balance sheet heading, you would have to write the words you usually write, no, balance sheet as on 31st of March 2022. You need to write there balance sheet and reduced, very important, and reduced as on 31st of March, because this restructured balance sheet will look very clean. People might get deceived by this. It might affect their decision making. That should not be the case. We need to make full disclosure. We need to tell the user of the instrument that this clean looking balance sheet is after doing lot of repairing. How do we convey that? We have to tell them that this company has gone through internal reconstruction. How do we tell that? We need to use the words unreduced as on. The moment we use the words unreduced as on in the heading of the balance sheet, it signifies that this balance sheet is after the internal reconstruction. This disclosure has to be made for consecutive years, not just in the year of internal reconstruction. Yeah. Remember that. Then accounting entries. What will it be? Ouch. One moment. Something went wrong. So methods of internal reconstruction: alteration of share capital. What do? We subdivide the shares or consolidate the shares, or we convert the shares into stock. We change the rights of the shareholders. We reduce the share capital. We go for compromise or arrangement or surrender of shares. Yeah. So for the assets appreciated, the value of the assets when it increase, we debit asset, give it credit to capital reduction. If the assets are reduced or written off, assets will be credited. What will we do? We'll credit assets, debit capital reduction. If the assets are sold, we'll write bank account debit and then credit asset account. If it is profit, we'll credit to capital reduction. If it is loss, we'll debit to capital reduction. Meaning any profit or loss in the process of internal reconstruction will be returned to capital reduction account only. We will not ready to separate P&L account. Yeah. Then if the liabilities are increased, liability increase credit, debit to capital reduction. If the liabilities are decreased, liabilities debit, credit to capital reduction. If the liabilities are settled, we need to write liability account debit, bank account credit. If it is we pay more than it is expense, we debit to capital reduction. If we pay less, it is profit, will be credited to capital reduction. I mean to say, any profit or loss will be returned to capital reduction account only. Done. If in case there is unrecorded liability which we pay, then again we need to write what to say capital reduction to bank. Why? Liability was not there, meaning it was there at 0 rupees, but we're paying money to bank account credit. We're paying entire money towards capital reduction loss. If unrecorded liability is waived off, then no entry. Why? For waiving of no entry, for unrecorded no entry, for unrecorded waive of no entry. Why? See, if you have to pay, then we'll write 2 bank account credit and write capital deduction because it is loss. We are not paying and it is not our loss, so we don't have to write any entry. Got it? And for any reconstruction expenses, in amalgamation we'll know realization to cash or bank. Here we'll write capital reduction to cash or bank. Done. And for reducing the shareholders right, we'll write old share capital debit, new share capital credit. Any difference will go to share capital reduction account. Yeah, old share capital debit because that's reducing, new share capital credit, difference will be created to capital reduction. Yeah, and if the shares are surrendered by them, then we'll write the entry share capital to share surrender. Share capital is reducing and we are receiving share surrender. This share surrender is like a liability. Yeah, if this share surrendered is issued to somebody else, then we'll write the entry what, liability to capital reduction, and share surrender will be transferred to share capital account because capital will become more again. We take the shares from them, we'll write share capital to share surrender. We give these shares to somebody else, we'll reverse this entry. This is a tricky part which people find tricky. Remember this. When shares are surrendered, we'll write share capital to share surrender. When shares which are surrendered by the shareholders are issued against liability, we'll reverse this entry, right? Share surrender to share capital, and that money what is there in liability will be closed by transfer to capital reduction. That liability is no longer there. Basically, from shareholders, the share will go to liability holders. That liability will become our profit. We don't give anything new. We take from shareholders, give it to liability holders. That liability has become zero. Correct? No. Total shares issued is remaining same, but liabilities is reducing. That is our profit, which will go to capital reduction. Done. If it remains unissued, then we will not credit share capital. We will write it off to capital reduction account and then close. Our share capital has reduced and nothing else. That is our profit. Done. This balance what is there in capital reduction will be used to write off goodwill, intangible assets, that is goodwill, patents, anything, or any accumulated losses or any assets which is overvalued. Yeah, and balance will be transferred to capital reserve. This is one point that you need to remember. Any balance remaining in capital reduction account after the revaluation of assets and liabilities, writing of accumulated losses, and the entire revaluation, entire reconstruction process, it will stand transferred to capital reserve. This, my friends, is the entry. They might sometimes ask you to prepare ledger, that is capital reduction account. You prepare the same by posting these journal entries. And don't forget, when we prepare balance sheet, we need to write the words. Say it after me. What word should we be writing? Say it out loud because you need to remember it till tomorrow. What word should we write on the balance sheet when we prepare it after internal reconstruction? And reduced as on. Then we'll write the date. This is what you need to write over the balance sheet, above the balance sheet, just before you go for preparation of balance sheet after internal reconstruction. That, my friends, is the topic of internal reconstruction. I've summed up some questions here in this material from the past examinations, all the past examinations, RTPs and MTPs. I hope you will use this for revision, and this file will be shared to you. I am CA Rajavardhan. You can find me and then ping me. It's already shared in the Yashas Academy and Academy official Telegram channel. You will get it there. If not, if you don't find it there, ping me and I'll share it to you. Yeah, and so far we are done with the topic of internal reconstruction also. In the module 2, one chapter that we left with is liquidation. So this is the end of second part of your marathon revision for CA Intermediate Advanced Accounting. I am CA Rajavardhan, helping you all revise it for tomorrow's examination. See you in the third video. The third video will be doing liquidation of companies, financial statements of banking companies. If time permits, we'll also do NBFC. If not, no. Technically, we'll be doing these two because banking is a big chapter, so is liquidation. Consolidation, when you start doing the problem, it is big, but conceptually, it is not that big a chapter. So we'll do NBFC, consolidation and partnership in the fourth video. That will be the last video. The third video will be doing liquidation and financial statements of banking company. Hoping to see you all in the next video. Till then, remember, life is not a battle to be struggling, guys. It's a game to be enjoyed. Till the time you're learning something, you're having fun, it's all good. The day you guys either stop learning something new or stop having fun, trust me, you might start struggling because you might be in a battle. So thumb rule to stay happy is pretty simple. It is to stay in the game. So for one last time on this day, I have just one simple question to all of you. Are we in the game? I really hope that your answer is yes, we are in the game. See you all in the next one. Till then, tata, bye-bye. Take care.